When somebody invests, they have to assume that their prefrontal lobes are going to shut down. The prefrontal lobes are the newest part of the human brain. The oldest part of the human brain is the brainstem, and what sits on top of the brainstem is all of these different parts of the brain that really manage emotion, the amygdala, the R complex, the reticular activation system. Those are parts of the limbic system that manage keeping the human, keeping the body, keeping you alive. And its only job, the limbic system's job, is really say, can I survive this? Can I survive this? Can I survive this? And if it doesn't think you can survive this, it takes evasive action. So I don't care if you have a high IQ. In fact, higher IQs return poorer results in the world of growing money, because you can have the best strategy in the world, but if your strategy is not designed to assume, to presuppose that your prefrontal lobes will shut down under stress, then it's a strategy that's going to fail. Hey everybody, this is R.C. Peck. So good to have you here for my weekend podcast. It is episode number 340. And the theme, or at least one of the themes for this weekend podcast, is talking about news and almost how news it almost feels like news puts us in a prison, right? We are stuck to the news. We are stuck to information. Information is what we need, and we have so much information, and information is free. And yet, it's my experience that we are actually less free today in some ways than we ever have been. And when news comes out, we put too much weight on it. We think news is too important, and we almost kind of live in a jail in relationship to news. And people look and sort and seek for information, news for the stock market. And I think that is a downfall. And so what I'm going to do is I want to show you 3 price charts where really the only time that news matters is this one thing. Really, and in many ways you can forget news and follow this one thing. So the first price chart I want to show you is the S&P 500. And it hit new lifetime highs. So never on the history of planet Earth is about 5.5 billion years old, the S&P 500 has ever been this high, both in a kind of total returns and without dividends reinvested, which is what total returns means. And it broke higher. Now, what's so important about this is the S&P was going sideways for 24 months in a 15% channel. Now, we don't know yet if it's legitimate, meaning we have to make sure that this breakout is confirmed. And that would look like the black line on the upper right comes back down to sit on the red line and then move up again. To me, that would be a confirmation move. Not that anyone is asking me what the market should do. But this is a pretty important move because for the last 24 months, the stock market's really been thinking about, what do I do? And if we look at it, what it's been doing, it has been digesting the previous 5 years of moves before that, which were pretty amazing, from the bottom of March of 2009 all the way into 2015, call that May of 2015. So it had to digest a lot of information. But it has broken out to new lifetime highs. Now, another thing that's really interesting, there was all this news around the Brexit. Well, the Brexit wasn't really news. It was kind of in the news cycle for about 12 months. So the stock market had a lot of time to digest what was going on with it. And certainly in the last month or two of the Brexit, it was a pretty close call, meaning whether it was going to be a leave or a remain, right? So maybe leave was up 52% to remain 48%, or maybe they switched back and forth. But at no point was it ever like remain is 90% and leave is 10%. So it wasn't that big of a surprise to the stock market when the UK voted to leave the EU after 43 years. And if you look at the screen right here, this is basically the Brexit vote right here. It came down, stopped, got right back where it was, and then moved to lifetime highs. So what should have been bad news actually was good news for the market. And that's what you want to follow, and that's what's most important if you ever do watch news, is to see how the news actually affects what you're looking at, in this case, the S&P 500. And what, quote unquote, should have been bad news was good news. And that's one of the reasons why I think this is a very legitimate breakout. The second price chart I want to show you is an advanced decline line of the New York Stock Exchange for common stocks. Basically what this does is it looks at the New York Stock Exchange's common stocks, and it just measures how many of them are advancing and how many of them are declining. And if more of them are advancing, the line goes up on the price chart that you see. And if more are declining, the line falls on the price chart. Well, as you can see over this 2.5-year period, the advanced decline line could not get above the May 21st, 2015 highs. It couldn't until just recently. So that, again, puts more legitimacy on this stock market breakout. Now, the thing I want you to remember is if you want to get control back over your future again, then you're going to want to align your money to the market and not necessarily your age or your financial religion or your belief system, because aligning your money to the market is what's going to be most effective for your wealth. And so you may not want the stock market to move higher. You may believe it shouldn't move higher, but it is moving higher. And that's what I mean by alignment. You align your money to what the market is actually doing, not what you want it to do or what you think it should do. And then the last price chart I want to show you is, this is a price chart of the 30-year U.S. bond chart. It goes back to about 2007. People go into the bond market when they're scared. Now, things are a little wonky these days because you've got Japan and Europe and China really messing things, and the UK now, really messing things up with their interest rates and money printing. But what's interesting about this is if you look at the red line, generally speaking, the price of the 30-year bond bounces off that red line. But when we had the Brexit vote and when the stock market broke to new lifetime highs, you have the 30-year bond price breaking to new lifetime highs. So you have the thing that people move into when they're scared, and you have the thing that people move into when they're not scared happening at the same time. Now, it's very likely that the price chart that you're looking at right now, the 30-year bond, what it's saying is, hey, you know what? That's kind of a blow off top. I'm breaking above and I'm moving back down. If that price moves back below that red line, that's going to give more legitimacy to the breakout of the S&P 500. And so that's what you want to do. Like when you believe in an idea, say, the market's in a new bull market, look for evidence why, and look for evidence why it's not in a bull market. Okay, so the question is, what do you do with this information? What is the takeaway? Okay, well, the first takeaway is, or kind of the main theme of the takeaway is, direction matters most. And there is a possible change in direction upon us with the price of bonds. When the price of bonds fall, that means the yield goes higher. And that's possibly what just happened. Maybe not forever, but it looks pretty, well, we'll see how long it holds, but it looks, at least over a short-term period, that bonds have made a temporary high, especially if they continue moving lower. The other thing is, maybe this is a change in equities too, right? The stock market has been stuck in a 24-month, the S&P 500 has been stuck in a 24-month 15% channel, and it's just broken out. So that means something. I think what's most important is why it broke out. Now, you don't always have to know why. What's most important is which direction it broke out on, and did it break out on what most would consider negative news, neutral news, or positive news. And I say it broke out on negative news, which means there's a lot of strength in this breakout. But I think probably another thing that's most important is this is a rally or a move higher that is sitting on the back of a handful of central banks. The Japanese, the UK, the European, the Chinese, and the US central banks. That's why this market is moving higher. Even if the US central bank does nothing, you have those other four major central banks manipulating their currency, manipulating what assets they're buying in the world, and looking for ways to create inflation in their economy, and that is not being lost on the S&P. So the takeaway is, have a strategy that aligns your money to the market. Have a strategy that is not based on diversification, but that is based on probability. And again, guys, what these weekend podcasts are about is helping you get back control over your future again. This is just another step in helping you protect and grow your future, grow your security, and grow your portfolio. Until next time, this is RC Peck. Hey guys, one of the best things that you could ever do is get a second set of eyes on your portfolio. But really, it's not looking at your portfolio that matters most, because that's not where the answers lie. The answers lie in the behavior that the portfolio sits on top of. And that's the difference that makes a difference for people. Unfortunately, when most people go and get a quote-unquote second opinion, they're just going to a conventional person or a very orthodox financial advisor, and they say, yeah, it looks good, be diversified over 10 asset classes and rebalance them. But you need to kind of find that unorthodox person, that unconventional person that understands it's the behavior that creates the growth or the lack of growth in a portfolio. And that's why my clients come to me. That's why people come to me who aren't my clients, say, give me a second opinion. Look at my portfolio. What do you see that I'm not seeing? Where is that biggest gap? Because RC, I want to take control back of my future again. And I've lost the runway. I've lost the revenue runway, meaning last time the market crashed, I was 50. I'm 16 years older now from the dot-com crash, 8 years older from the global financial crisis crash. I can't have this happen again. How do I avoid the loss? If you have curiosity in finding out how to make sure you do avoid the loss, then the next step is super easy. Just go ahead and give Patty a call, or you can email her, Patty, Patty, at fearlesswealth.com. Thank you, everybody, for being in my world. Have a great weekend, and I'll speak to you next week.